Hey everyone, Mitt here. The markets have been moving a lot over the last 48 hours. And if you've been watching the headlines, it's easy to feel like something major just changed overnight. So in this video, I want to break down what actually happened, what it means, and how long-term investors should think about it. So what happened in the last 2 days? Over the past couple of days, we've seen a sharp shift in sentiment across markets. A few things have been driving it. Stocks reacted quickly to new information coming out about inflation, interest rates, and earnings. Bond yields moved, which is always a signal that expectations are changing around rate cuts or future tightening. And overall, the market is doing what it's always been doing in moments like this. It's repricing risk very quickly. This isn't necessarily a sign that the world changed. Is just a sign that expectations changed. And a large factor of that has been, new models in AI have been launching, and it feels like it's been displacing a lot of software companies. And so you're seeing a shift in where investors are really unsure in the stock market. And so they're selling out in their positions and saying, you know what, they've captured enough upside, and they're going to the sidelines. Except with all the automated trading that goes on and people shifting out of their positions, when there's a large sell-off, you're seeing these large dips. And it's been hitting the tech sector really hard, which is where we've been seeing the gains. Especially as we're seeing that, robotic process automation tools and AI are implementing in businesses. Unemployment continues to tick up and stay high. We've been living in a world of two places, where the average individual, or let's call it the people who work a minimum wage job, continue to be displaced. There's less opportunity for the unskilled. And the last while, market earnings and performance of companies has really been driven by the tech sector. And now that AI might be displacing some of these software companies, it's causing the gap and shift to increase even further between the average worker, an average person, and reality. The biggest thing investors need to understand right now is this. Markets are extremely sensitive to interest rates. Even small changes in inflation expectations or central bank messaging cause big moves, because valuations are built on discount rates. So when rates move, everything moves. Equities, real estate pricing, financing costs, investor appetite. That's the environment we're in. Not crisis, just uncertainty. Here's the key takeaway. Short-term volatility is normal. It's noise. Long-term investing is about positioning around fundamentals, strong assets, stable cash flow, disciplined leverage, and time in the market, not timing the market. That's why we focus so much on real assets like housing. Because even when the markets swing, people still need a place to live. And the AI bot might be able to do your job, but you're still going to need a place to live. And so from our perspective, the opportunity right now is actually improving. Higher rates and uncertainty create motivated sellers, less competition, and better entry points. We're continuing to stay conservative on underwriting, focusing on cash flow first acquisitions, and building long-term value through operations. The headline moves matter, but the fundamentals matter more. If you want, I can keep doing short updates like this when markets move quickly. And if you're an investor and want to understand how we're positioning through the cycle, feel free to reach out or check out the links below. Talk soon.